Okay, welcome everyone. Today we are looking at trading Forex reversal patterns. And one particular pattern that we'll be looking at will be the double top and double bottom reversal patterns, or two different patterns that we'll be looking at. So just a quick disclaimer before we get started. This is for educational purposes only. If you have questions about your individual investing needs, I recommend you talk to your investment advisor. Okay, so in this webinar, the agenda for today, we will again define what double top and double bottom patterns are, what they look like. We'll also take a look at how do we trade these reversal patterns, where do we place our entry, where does the stop loss go, and how do we identify the target levels in regards to double top, double bottom. And also how do we properly implement this strategy so we are becoming a consistently profitable trader. So for those who don't know me, just a little bit about myself. I'm a full-time trader. I've been trading live for about the last 8 years. In terms of my background, I have a computer science degree, bachelor's in technology, and also 2 MBA degrees, one from Cornell University, which is an Ivy League university, and another one from Queen's University in Canada. So prior to trading, I actually was in IT consulting for 10 years. I ran my own consulting company, and then I worked in the banking sector, worked for one of the largest banks in Canada here, and then I got into trading, and now I'm trading full-time. So I have a family, I'm a mom, and wife and all of that good stuff. And my website is tradingwithvenus.com. That's probably where most of you guys know me from. All right, so let's jump into what we are going to be talking about today. So one of the basic concepts, the first thing that we learn about trading Forex is about trends, trending markets, an uptrend and downtrend and sideways trend. So an uptrend is when the market is making higher highs and higher lows, which basically means that the price goes up, it pulls back a little, and then goes up again, pulls back a little, goes up again, and then pulls back. So continues on. So one thing to keep in mind is that trends don't continue on forever. There are periods of consolidation, and then we get reversals, and then we may either get a new trend or we may get a continuation of those trends. So the trend trading strategy is not the only strategy. So there are times when the trends are changing, and there are strategies to take advantage of those changing market conditions. And trading market reversals is essentially one of those strategies. So first thing would be to identify what kind of a market it is. So once the market has been trending for a while, or it has trended for the last few days, we can then start looking for reversal points in the market, or at least consolidation. Once we get the consolidation, the next would be potentially would be reversal. So that's what we're going to talk about here today. And again, the definition of downtrend, when the market is making lower highs and lower lows. So it's a stair-step type of process. Again, so market moves down and then pulls back up as people take profit, and then it goes down further, pulls back up, and drops down further. So this is again our downtrend. And as the downtrend becomes consolidation and then changes direction, one of the patterns that we can identify in the market at the time would be our double bottom pattern. And that's what we'll be looking for to give us an indication if the market is changing. So it's one of the reversal pattern. We'll touch on what some of the other reversal patterns may be, but this is one of it. And again, the other type of market, the third type of market condition that we may see would be consolidation or a sideways trend. So this is also called the range-bound market. So in this kind of a market, price establishes a resistance area that it's not able to break, and also a support level that it generally is not able to break. And in a range-bound market, price will just go up and down between these two lines, the support and resistance line. Every time the price goes up to the resistance area, it will push off of there, retrace off of that level, and go back into the range. Every time the price goes to the support, it will bounce off of that level as well and then go back into the range. So these reversal patterns can actually be used in both type of market conditions, after the trend is ending or if it's a consolidating or a range-bound market. So the difference really is, in a range-bound market, we'd be looking for a double top over here, for example. We'd be looking for a double top at the resistance line. Once we draw our range-bound market here, our market range on the chart, we are looking at the resistance level to show us some sort of a double top pattern so that we can actually take the trade short back into the range, or we'd be looking at the bottom of the range, and if we see a double bottom pattern like this one, we can then trade it back into the range. So that would be just a quick overview of trading this for a range. And in terms of downtrend or an uptrend, we'd be looking for the trend to exhaust itself. Once we see signs of trend exhaustion, double bottom is a sign of trend exhaustion here as well, then we're looking to trade it in the opposite direction, looking for at least a decent size of retracement or a trend reversal completely. So reversal pattern. Reversal patterns show us change in market direction. So if there's an uptrend, we are essentially looking for market to turn and go either sideways or go down. They can be both bullish or they can be either bullish or bearish reversal pattern. So if the market is going up and we get a double top, so that's a bearish reversal pattern, then we expect the market to come down. If its market has been going down, we would look for a double bottom and looking for signs for the price to reverse. So that would be our bullish reversal pattern. And these set up on multiple time frames, so you don't have to stick to one particular time frame. So if you are more of a longer term trader and you trade from a daily or a 4-hour chart, you can look for these reversal patterns on a 4-hour chart or a daily chart. So the longer the time frame, more meaningful the pattern will be, which means that you will get more pips from that particular pattern. You can also trade them on a 5-minute chart or a 15-minute chart for a day trader, and the number of pips you would get from those would be slightly less. But if that's what you're doing, like me, you're depending to make money on the market as your job, then that would be something that you can trade. And these set up all the time. So these are my go-to bread and butter patterns that I see in the market very, very often. There are various reversal patterns, head and shoulders pattern, double top, double bottom, engulfing candles, or morning star, evening star patterns. All of these are different types of reversal patterns. We will cover some of these patterns as we go along in our webinar series, but today we will only look at the double top and double bottom reversal patterns. Okay, so the double top pattern, it's formed after an extended move up. So price would have been trending up. The tops are peaks formed when the price hits a certain level and can't break it. After testing this level, the price retraces slightly, but then retests this level again and then bounces off of that level to form a double top. So let's take a look at an actual chart here, or a picture of a chart so we can understand. So basically, price would have been moving up. So price is making higher high, higher low, higher high, higher low, and it's moving up. And it comes to a point, a support and resistance level, where the price is not able to break that level, and then bounces off of that level, pulls back from that level, and then goes and tries to test that same level again. And then again, we get a candle, rejection candle, some sort of a rejection candle at this point, and then price starts to come back off of that level. So it also looks like an M, so it can be called an M pattern. So price is going up, pulls back, then goes back up again, and then pulls back. So this is so it's either, you can call it an M pattern, or you can call it a double top pattern. So basically price, there will be some support and resistance level. So this will be our support and resistance level here. Price will go up to it. It's moving higher. It's making higher highs, higher lows. So trending upwards, then the price starts to get exhausted. So this is what we call exhaustion in price, where the price gets to a level, then pulls back, and then tries to test the level again, and then pulls back off of that level. So this looks like an M, or looks like a double top here. So two different peaks or tops are formed. And then we have this neckline. The point where the price bounces off to the first time before it goes and tests the level again, that is called our neckline. So if we just draw a line here, that will look like a neckline. And this is where we are looking for our trade entry. Let me just clear that. So it signifies the end of a bullish move. We saw that the price was moving up, and this is a bearish reversal signal. Once we get the double top, especially on a higher time frame, it's a very good signal that the market is exhausting, and now we may start seeing the market go in the opposite direction. So very, very good signal there. And can be used in trending as well as range-bound markets. We just talked about that. If the price had been going up, we look for trend exhaustion, or if the market was just range-bound going up and down, we would look at the outside ends of the range. So we will look for a double top at the resistance level and double bottom at the bottom of the chart, bottom of the range. So let's take a look at how do we trade this. So this is the same chart here. We see the price has been going up. It goes and forms a first peak and then retraces off of that, goes back and tests the same level again, and then bounces off of that, comes back into the neckline. So now there are two ways to trade this one. There's an aggressive way to trade it, and then there's a more conservative approach to trading it. And I will leave that up to you, however you like to trade this. And I'll just share some viewpoints on what are some of the things you want to watch out for, whichever way you choose to trade this. So the first, let's take a look at our aggressive approach. So let's say you want to get into this trade. First thing you could do is, let me just move this out of the way. Okay, so you could take an entry over here. And the reason this is a good entry is because the price has tested this level twice now, and we see this nice pin bar. Most of the time, you will see a nice pin bar, either a nice pin bar the second time around, or some sort of an engulfing candle pattern. So because of that, it gives us, as long as there are clear double top. So we could get another candle here, which could be going, let's look at some of the patterns here. So we may get this type of a pin bar pattern, or we could get another candle like this that totally engulfs this green candle here. So that will be an engulfing candle pattern, or we could get a morning star, evening star pattern, which would be valid as well, as long as we see two different peaks here, and we see a clear candle pattern, candlestick pattern that shows us that double top has been formed. So in that case, you could take a trade right over here. And in this case, the benefit of this is that our stop loss would go above these pins. So take the highest pin and put it on top of that, give it a few pips, just so that the trade has some room to breathe. So this is where your stop loss will be. This is where your entry would be. And then your target would be at the bottom here. So one quick thing about this one here, aggressive entry, your stop loss is very, very small. Right? Even if you're wrong, your stop loss is very small, and you take a small loss, but then your profit target is quite big. So your risk to reward in this case is very, very good. So that's an aggressive entry. And one thing you need to watch out for aggressive entry, very, very important thing, is that when the price comes to this neckline right over here, When the price comes here, this is your first profit target, because sometimes what can happen with aggressive entry is that price comes here and then bounces off like this, or it may do one of these and then bounces off of that. So you could give your profits back when the price does that, and then it may just continue upwards like that. So that's something that you have to be careful with when you're taking this trade aggressively. Your stop loss is small and your risk to reward ratio is good. However, there is a chance that this could happen, that the price comes to the neckline, and it usually comes to the neckline, and that's just based on what I have experienced in the markets, that the price was generally, when we get a double top like this, will generally come to the neckline. So that's why that is your first profit target, so that at least you take some money out of the market. Once the price gets here, we are looking for the price to break through, just like this candle here. So if the price breaks through this level, our double top pattern is valid and it will continue on, and you can trail your stop behind the candles. However, if the price starts consolidating at the neckline, the chances are quite high that the price will go up again. It's very important that this neckline gets broken. So if you have an aggressive entry, I would say cut it out somewhere here. So you take half your position here and the rest here with break even +5 or whatever type of chart you're trading. So you have some entry and you get out of your trade with profit. So you have to be mindful of the neckline. So that is our aggressive entry. So what if you're a conservative person, you want confirmation that this is actually going to work out, or higher chances of this pattern working out? You would then take a trade at the break of the neckline. So this is our neckline. So once you see that your double top pattern, which is also your M pattern, has been established, once you see double tops here, you are good to go, and you are looking for a break of the neckline here. And as the price goes through here, as the price breaks through, when the price retests this is where you would take your entry. So the price, so the candle will look green at this point because it's retesting this level. So price closed here. It's a nice solid candle, which means it's a nice good size. So it's not like a tiny little candle here. Tiny little candles usually mean that the price doesn't have any momentum in it. Once you start seeing large candles, that's good for your entry. So you see a nice engulfing candle closes into the neckline, then you look for a bit of a pull back up in price, and you take trade short here at neckline, and then you are looking for price to go exactly the same distance as the neckline. So from neckline to the top would be your same distance that you're looking for price to go to. So you have 1-to-1 risk to reward ratio. In an aggressive entry, you had 2-to-1 or even better, but in this one you have 1-to-1 your risk to reward ratio. So again, your stop loss would go above the high here, and then your entry is at neckline, and you're looking for the same distance from the top to the neckline, the same distance you're looking as your target for your neckline to the bottom where you're going to put your profit target. So at this point, this would be a first profit target. If the price continues through this, you can keep trailing your stop so you can get a bigger part of this trade. However, if the price starts to turn there, you get your first profit target is hit. If it starts going back up again, you can get out of that trade. So at least you get 1-to-1 risk to reward ratio in this case. If you just wanted a straight trade, you didn't want to trail anything, you can just set your profit target the same distance as this one here will be a profit target, and then you just close your trade out. There's no, real need to manage it further, and you are done with your trade. So any questions about double top pattern here? All right, so let's continue on. So again, like we talked about the entry criteria, we enter on the test of the neckline. So once the price has broken through the neckline, look for a back test of it when the price comes back and tests the same level again. Our stop loss would go above the tops in this case because we are looking for price to go down. and this will be a short entry. We are taking a short, so we are bearish in this scenario. Our target will be the same distance as the high point of the tops to the neckline. So we can just measure that, and then we'll place our target, our take profit at that target level. So here, just to go back on it again, we have double top, we get a neckline. Neckline is the middle part of the M, or the double top here, where the price comes back and tries to go off of again. This will be our neckline. Once the price gets through this neckline, on the back test of the neckline, we go short, and our profit target will be the same distance as the top here. All right. Now let's take a look at a double bottom pattern. So a double bottom is, again, a trend reversal formation. The bottoms are valleys that are formed when the price hits a certain level and then can't break it. And then after testing this level, if the price bounces off, so we'll draw it here. So we have price moving down. It hits a support level and then bounces off of that level, comes back to retest this level, and then bounces off of that level again. So we get what looks like a W, or a double bottom. So this is the bottom, and this is the bottom, and this is our neckline here. Oh, it's not drawing too well. So let's take a look at an actual picture of it. So here we see image of the chart here. Price is making lower lows, lower highs, lower lows. So it's nicely moving downwards here. So price comes to a level, which is this level here, where it's not able to break through. So let's draw a little support and resistance line here. This one here, price comes and hits this level, then bounces off of this, goes into forms at some point, it forms this neckline here, the middle part, and then tries to go back down. So the sellers are trying to push the price through one more time, but there just aren't enough sellers in the market to be able to push the price through, and the price bounces off. And that's where we get this W pattern. So some people will also refer to this as a W, which is fine because it looks like a W. So we have two bottoms or valleys here, which form our double bottom of the pattern. And then we are looking for the price to break through the neckline and then continue upwards. So the double bottom pattern, it occurs after extended downtrend. So the price would have been moving lower and lower and lower. And we saw this in case of the British pound as well, where the price was, after Brexit, the price was just kept on going lower, and everybody and their neighbor thought that it would continue going, but then we've bottomed out. The downtrend got exhausted, and we had a nice move to the upside. And now we'll see what happens this week. But it was, the price had moved up, and now it has retraced off of that level again. So the trends don't continue forever. There comes a level where the price just has trouble getting through, and that's the price line. That's the level that we are watching for to look to see these patterns. So it's a bullish reversal signal, which means the price has been going down, and we are looking to take a trade to the upside, and we are looking to go long. And again, this can be used in trending as well as range-bound markets. In the trending market, we are looking to take a trade basically at the top of the trend here. So we would have some sort of this type of a move, right? And then we would get our trend line, and we're basically now looking for the price to come down. So it was a nice uptrend. It's broken, and then price comes back down. In terms of range-bound market, we have two lines. We have a resistance line up at top and the support line in the bottom. So price just goes up and down like this, and some sort of a movement like this. And then price comes to the bottom, and may do one of these, and we're looking to go take the price to the top of the range again, and then we may get a double top pattern. So we would only be looking for this pattern over here, not here, not in the middle of the range, anywhere, just in the bottom. So you can use reversal patterns in all kinds of markets. It can be both in trending as well as range bound market. You just need to know where to look for that particular setup to form. Okay, so this is our double bottom here. We saw the price was coming down, then comes to a level which it can't break, then pulls back off of that level, comes back to test the same level again. And here in this case, the first time we got these pins, which is a rejection here as well, shows rejection. And then we have a nice engulfing candle here. So this gives us our double bottom. So price came to this level, rejected, came back to this level and rejected. And once the price breaks through this level, we can take a trade on pullback, and then we are looking for our target. So let's look at what an aggressive entry will look like in this case. So once we get this engulfing candle here, the green engulfing candle, this is where we can take an entry. Our stop loss would go here below these pins. So this is stop loss, this is an entry. And as you can see, our stop loss is quite tight in this case. So it's very small. So even if you're wrong, we only take a small stop loss. Our first target would be the neckline right here. This one here would be the first target. And the reason we want to make this our first target, and when I say first target, I mean take something out of your trade, So take a profit, whether you close half of your trade out or some portion of your trade out, 80%, 20%, whatever. Take some profit, because the way we looked at in the double top, what could happen here is price could just do one of these and then not be able to break through the neckline. And that happens when there's a strong trend. When the trend hasn't quite exhausted itself, it's just a pullback. This can happen. We can still get a double bottom formation, but it does not break through the neckline, and then price could slowly just creep back down again. So to prevent this from to prevent ourselves from getting caught in this type of scenario, you would place the first target at the neckline, because generally price will go and test the neckline. If it starts consolidating and is not able to break through the neckline, we know that chances are really high that the price will start coming down. So it may be a good idea to just close the second half of your trade right here, so you're still in profit. And that's the reason for taking a aggressive entry, is because you would still get your profit or some part of the profit, whether you take half here and half here, you're still profitable, and your stop loss is quite small if we are wrong. So this is good for people who are aggressive, who like to take a lot of trades or like to get into the move quite early on. So the second target would be here at the top here, which would be the same distance. So you get a lot more, your risk to reward ratio is really high, your stop loss is really small. So this can be good. However, it is an aggressive way of entering. And if you're not quick with getting out of the trade, you may see your trade go back. You could be in the profit, and then you get stopped out. So be mindful of that if you take an aggressive entry, you're able to manage your trade accordingly. So let's take a look at a conservative entry now. So the first thing we would have to, again, look for is a support and resistance level. So you would draw your support and resistance level. This will be pre-drawn, so you could look at your higher time frames. So if you're trading a 15-minute chart or a 5-minute chart, you can look to a 1-hour chart for your support and resistance lines, or even 4-hour or 1 hour. So this is some sort of a support and resistance line that you already have on your chart. So once the price comes down, it's trending down, it comes to this level, but just is not able to break it, pulls back up, then comes back down again, test the same level, but it's not able to close below that level. We'll see some sort of a rejection candles here. It could look like these pins. It would be, or it could be something like this, where it's an engulfing candle, but something, some sort of a reversal candlestick formation where we can notice two different bottoms. And then we will wait for our entry when we are conservative. So we would wait for this neckline to get broken. So we're looking for price to get through this level. Once the price gets through this level and it comes and tests this level again, in this case, the candle would look red, and we are actually taking an entry into a red candle because we are expecting it to go up like this. So this is where your entry would be, and your stop loss would go below the bottom here, and your target will be the same distance here from the top to the neckline. You would just extend it out, and that would be your profit target. Stop loss would be a few pips below the bottoms here. So your risk to reward ratio is 1-to-1 because you are conservative, and you have decided to have a safer trade and not have your stop loss getting hit. In this case, there's higher chances of the stop loss getting hit if you take an aggressive entry here, but here we have a confirmed entry. It's a higher probability trade at this point, and you can just look for 1-to-1 profit target, or you can trail it behind the candles so that you let your trade run. So, we always hear about letting your winners run, so you can trail it behind the candles as the price is moving up. So you may be able to get more than 1-to-1, but I do highly recommend that you take some profit at this 1-to-1 level, because sometimes what happens is price may come here and then start consolidating, or it may start coming back down here as well. So make sure you're taking profit and not just holding on to the trade for even larger results, because sometimes that can just go the opposite. So this is our double bottom. So when I talk about a 1-to-1 risk to reward ratio, what I'm talking about is if you are placing your trade here, for example, if placing your stop loss here, for example. So let's say your stop loss to your entry is, let's say, 25 pips, right? And then your target will be 25 pips as well. So that's what makes it 1-to-1. So 25 pips is your risk, and then you have 25 pips of profit that you're looking for as well. So maybe let me do this. So here, if your stop loss is 25 pips, you want to make sure you have 25 pips to the target as well. So this will be 1-to-1. And if you took an aggressive entry here, you will get additional pips in here. All right, let's move on. Okay, so what we just looked at, entry will be on test of the neckline. We're waiting patiently for the neckline to break, and then we enter into our trade. The stop loss will be below the bottoms, and we are not just, we want to make sure we give it little room for the trade to breathe, so that, because sometimes what it can do is go and test it the third time. So we want to make sure that we don't get stopped out just because the price is testing the level a third time. And again, our target would be the same distance as the low point of the bottom to the top of the neckline. Okay. All right, so let's get into some examples now. So this here is, the pictures sometimes look quite pretty, and what we see on the charts can be quite different. So this is an example where the price was moving up. Here it was going up and pushed up, went into this here support and resistance area, then pulled back from it, then pushed back up here again, and then pulled back from it. So here what I have is the entry is right here, and the stop loss will be on top of the pin here. So this is an aggressive entry because we are not waiting for the our neckline to get broken. So in this case, this is our neckline, right? Actually, it could be slightly higher. So the neckline is right here. So neckline is basically this level here. So the price is price is going up, hits a resistance level, pulls back, and then goes back up again right here, and then comes back. So this looks like an M here, and this is our neckline. So once the price breaks through the neckline, see how it breaks through and then goes back and tests this neckline? So that this is where we would take our entry. So the one, so you can take an entry here, or you can take an entry here as the price is testing the neckline. This here is an aggressive entry, so your stop loss is right here. And what could happen is price could come here. If you're in aggressive entry, it may do this and start going back. That's why you have to make sure if you have an aggressive entry, you take some profit here. At least, you know, you get rewarded for the aggressiveness here, and at least you get some money out of this trade, and then you can close it out if it starts going back again. So in terms of conservative entry, so this is your neckline. See where the price has trouble going through. So the bottom here, that's what you're looking for. And then the price goes up and then comes through here. So once it crosses, see how this candle, the red candle closed below this, and then the price pulled back. See how the price is staying below the neckline? So once the price starts holding below the neckline, it's, you know, you could take your entry right into the neckline, or you can wait for this engulfing candle to close. Your choice. The target would be the same distance here and to the bottom. And in this case, the good thing about trade management is that you can, excuse me, you can trail your stop. See how it just, the price just gets a lot of momentum, just blows through. If you had 1-to-1 risk to reward ratio, I mean, you would do really well, because you would still get over 100 pips out of this trade. But what could happen is price could pick up momentum like this and then keep on going. So you could trail your stop loss, and this comes down to trade management. The simplest way to take this trade is entry at neckline, stop above, slightly above the high here, so maybe over here, and then your target would be 1-to-1. That will be the simplest way. And if you're a conservative trader, but you could also trail your stop behind the candle, so you get some of this price action or, you know, profit in your trade. So that's another way to do it. And if you are aggressive, more of an aggressive trader like me, you could just take your entry once you get a clear sign that a double top has been formed. So in this case, a peak is formed, another peak is formed, and then you have a couple of engulfing candles that suggest that the price is going to go down now. You can take your entry here, and then to get out of the trade, what I do is I look for an engulfing candle or a reversal chart pattern or a trade pattern in the opposite direction. So here what we see is, if you look at these candles, the candles are nice. They're increasing in size, which shows that the trade is picking momentum. And then we get this pin bar. Once you get this pin bar, I would be very, very cautious, because I'm looking for a trade to go back up now. And this will be the level that I would mark on my trade to see if the price goes back above this level. If it goes back above this level, the trade is done. We are out. So here I saw another pin and I was worried. So I am looking for some sort of an engulfing candle here. So here I would be looking for an engulfing candle, which means a long green candle. However, we did not get that. So all we got was a little tiny green candle, which means that the price doesn't really, buyers don't have that much control here, and price does another drop. And then we get this nice big green candle, which is a very solid engulfing candle, which means that now the buyers have come into the market and it's time to close the trade. We would exit here, because as you can see here, buyers start coming in and these green candles start becoming larger, whereas our red candles were larger here, which shows that there's momentum to the downside. Now the green candles start becoming larger and the price starts going up. So you want to make sure once you get an engulfing pattern or some sort of a reversal candlestick pattern in the opposite direction, you get out of the trade. This particular one is British pound Japanese yen 5-minute chart. So let me take you to the actual chart here so we can take a look at it. That's not the chart. Okay, so this is the actual real chart that I marked up here, just so that I could, you could see things clearly here. We have British pound, Japanese yen 5-minute chart, and this was very recent. This was July 21st when this set up. So we have, you can also use other things for confirmation. So if you're using any other kind of indicators, or you have other things that you use, you can use that as a confirmation of this. You can do it purely on price action, just have a support and resistance line drawn there and just look at the price and take this trade. Or in my case, I also have a pivot point indicator. This is my pivot point indicator. So in case of a pivot point, like you may have heard me talk a lot about pivot points, this was a very nice pivot point trade as well. It went into R1, blew through your daily pivot, and then went into S1 and gave us a reversal. So this was a picture perfect. If we were not talking about a double top here, it would be picture perfect trade, goes into from R1 to S1. Very, very nice pivot point trade. But anyway, we're not talking about pivot points here. We're talking about double top here. So in terms of price action, so what I'm trying to say is that you can use other things as confluence. I talk about confluence a lot, which means if you have multiple things coming up, if you have multiple things that are coming together, so you have your support and resistance level, you have your pivot point, or you may have something else telling you that this is the place where market may be reversing, you can use those things as confluence or confirmation that you are in fact seeing some sort of a reversal. Okay, so in terms of support and resistance line, your support and resistance lines, I don't generally draw my support and resistance lines on a 15-minute chart. The minimum support and resistance level that I would draw would come from a 1-hour chart. So nothing below, 1 hour in terms of a higher time frame support and resistance level. So this would support and resistance level would come from a 1-hour chart. If I can, oh, that got messed up. It's hard. Oh, here. It's kind of hard to see now because we don't have, I've written here, but see this support and resistance level. So let's go back to our 5 minutes so we can see that. See this yellow line that I've drawn? That was from 1-hour chart. So this is where we drew this support and resistance line from 1-hour chart. See when the first time price approached this level, it pulled back, had trouble here, had trouble here, had trouble right here, and again right here. So this is actually a double top in terms of, let me see if I can find a better picture here. Maybe let's use this chart here. So yes, this is the level. See how we have support and resistance level here. Price had trouble here, here, here again. So see how price came into this level, pulled back, pulled back, pulled back, and now we get a nice engulfing candle. So if you were trading this on a 1-minute chart, your entry would be, this is your neckline right here. Once the price closes below the neckline as the price is pulling back up, I usually like to take my trades when the price is pulling back up. So it will look like a green candle, and it can be scary, but it's okay because we have a confirmation here. See this nice big engulfing candle? This is a confirmation. So you have price went and tested this level again, tested the level second time, rejected with a nice engulfing candle. In this case, if you're trading the 1-hour chart, your stop loss would go above this pin here. Give it a few pips above because it can go back and test it again. And your profit target would be 1-to-1. So you're looking for, if this is, let's say, actually, you know what? We don't need to say because we can check here. So your entry is here, so 94 pips. So let's say approximately 100 pips. So your take profit would be 100 pips, so about here, right? So you would just put, so this support and resistance level right here would be your profit target. So you get a 1-to-1 risk to reward ratio trade. If you were trailing your stop, so I would still say take something out here and then trail it. So I do it on a 5-minute chart because then I can just kind of go along with the trade. But if you were just trading one 1 hour chart, you could place your profit target here, or you can wait for this engulfing candle. You can and then get out of this trade. So there are multiple ways to trade this. So the question is, can you trade off of the 5-minute or 15-minute? Do you find it easier to trade off of the 5-minute or 15-minute chart? So what happens with me is I am a day trader. So this is my job to come and take a trade. When you trade from a 5-minute or a 15-minute chart, you get more trades, right? You definitely get more trades, but the problem that can come is, one, it takes more time because you're staring at charts and you're looking for something to set up, and things can change quickly. So you have to be able to get out of the trade fairly quickly as well. And for a lot of people, especially if you are new to the markets, it could be quite noisy because price tends to chop more in on a 5-minute chart. There's definitely more noise. So you have to get used to trading that. Let me get rid of this here. Okay, so you have to get used to trading this. So this is our double top we were looking at. See how the price dropped. See how it can be choppy. So here you could have gotten out of the trade if you thought, oh, well, it's going to start going in the opposite direction now. So that can happen if you are not, if your eyes and your brain is not accustomed to seeing these patterns. It could be a little bit more noisy because here, this is what we're looking at in terms of the chart. We would have our support resistance line drawn here. If you're not totally comfortable with this, you may see that there's a lot of noise here. So that could be a problem. If you are newer to trading, I would not recommend starting with a smaller time frame chart. Smaller time frame charts are more for people who are scalpers, day traders, and want to be in and out of the market fairly quickly, because sometimes what I may do is just take an entry here and get out here. So if this started going back up here, you would have to ditch the trade here. So in terms of a double top or a triple tops are not found as often, right? So sometimes you may get like this, where this is sort of a triple top. 3 times price had trouble going through. And you can see as the price is going through, see how we have nice, huge candle here, green candle, big green candles, bigger, biggish green candle. And then it starts to get smaller. See how the price is going back and forth here? This shows exhaustion. So when the price is exhausting, sometimes what can happen is it becomes range bound like this, right? It starts to go trade sideways before it drops. So this sideways movement can create a double top, or sometimes it can create a triple top, right? So in terms of which one is better to trade, if you have a triple top, it's great because that means that the buyers really tried and failed. It's an extra confirmation, but you don't have to wait for triple tops because triple tops are not as common as double tops. Double tops are definitely more common, more prevalent. You'll see double tops way more often than you would a triple top. But we don't need to wait for triple top. We can just trade a double top. So let's take a look at an example of a double bottom. Here is a double bottom. This would be considered double bottom. This one would be considered double bottom here as well. But look at this one. See, this here makes a triple bottom, right? So sometimes you will find this, but not always. But if you were just looking at this level here and this level here, see how the price came down into this. So the price had momentum, came down here, pulled back, and then came down here again. See how it comes back here? So this here is a double top, and your neckline would be, I would just draw it right into here because we got like three different, and this is a 1 hour chart, so our numbers are a little bit more bigger in terms of our levels here. So look, I would look for this, I will look for this, see nice rejection, and then it could be a double bottom. So the question here is, after the double top, do I look for a bearish candlestick to go short? I prefer to see a bearish candlestick to go short. For example, let's take a look at this example. This is a double top here as well. Again, this is pound yen 5-minute chart. So here, our first top would be this one right here. Second is this one. And this is the neckline. Actually, this is the neckline right here. Let me get a better pencil here. Here. So you have, this is your, so you would have a support and resistance line somewhere in here. So this is your first test, this is your second test, and this is your neckline right here. So I would like to see some sort of an engulfing pattern here. See how we have two candles, two red candles here that take out this green candle. I like that. So I would place my trade here. This here particular one wasn't the best time to trade because this was a news event that came out. It was, I think it was the data for British pound that came out negative and it dropped. So I wouldn't necessarily take this trade, but this is an example of how this particular thing is also a double top. So sometimes when there is news, don't take the patterns, because it doesn't matter what pattern it is, it may not always play out. But let's pretend that there was no news here, then this is your double pot pattern as well. You're looking for price to test the level twice. You have your neckline, which is the, you know, the middle part here is the neckline. Once this breaks with the green candle, or with the red candle, sorry, you would take a trade. I like to take a trade into the neckline as the price is green into the neckline. So you capture a few more pips, but you can take it on the close of this red candle, and you're looking for a move to the downside. The rule of thumb is 1-to-1 risk to reward ratio here. And a lot of times you can get bigger moves, so you can actually trail your stop. Dollar CAD, let's go take a look at dollar CAD here. Let me find something that doesn't have, let's just pull out a new chart. Dollar CAD, new chart. Okay, so let's see. So sorry, where are we looking? Sorry, just to confirm, dollar CAD is a double bottom at H1 was the question. So here we are on H1. No, I would not say it's a double bottom. It was a double top here though. See, because the price came and tested it. So if you were to go to a 15-minute chart, for example, look at this. So here's actually another tip. So if you see this type of thing, price goes up, pulls back, goes back and makes a lower high, that's more of a confirmation that it's going to move down. So in this case, your neckline is right here. See this neckline? See how price bounces off of this level and goes up and then comes down. So if your second top is actually lower than the first top, that's a good thing. That's more of a confirmation that the price is going to drop at this point. See how it comes and tests this level again right here. Let me clear my drawing. See how price breaks through and tests the backside of the neckline right here. This is where I would take my trade as the price is going up, because I expect it to drop. Entry would be here. Your stop loss would go above here, and your profit target, let's find out. In this case, the profit target, so 1-to-1. So in this case, it's about 21 pips. You would put it at 21 pips, which would be about there, right into your R2 level, and anything extra you get is bonus basically. So you can trail your stop. And there was another question. Do you look for these double top M5 or M15 1 hour reversal off New York session or session does not matter? And the rest of the question is, do you have a set time frame that you start and end scanning and taking trades that result in best trade setups for you? So the way I view the markets is I always start from a larger time frame. I start from a daily time frame, actually. So the way I do my analysis is I look at what the daily is telling me, and that becomes my bias for that particular day. So in this case, we are seeing a rejection here, and we are into the high here, 31.84, which was a previous high. So this could potentially be a double top here if the price does manage to. So in this case, we don't have a clear signal. We see a rejection, but at this point, it could go either way. So I have no clear bias for this one, although I think because the pin is so big, my bias would be more to the downside than would be to the upside. And then I go to my 4-hour chart. I would mark my support and resistance lines like this, and then that's where I start looking for. And I would look for entries off of those bigger level. So I always start with the daily time frame. I trade from a 5-minute chart. When I look to take an entry, I would look for like this. I would place a trade into this neckline here. So I would take a trade here and look for it to go down. So my bias comes from, or trade direction, market direction comes from a larger time frame. My trade entry is on a shorter time frame. So here we have double top as well, and sometimes the double top can look like this. So let's take a look at the breakdown, the concepts behind this, why I am saying this is a more of a confirmed entry or a better trade setup, higher probability. Because definition of uptrend is higher high, higher low, higher high, higher low, higher high, right? So market is making higher high, higher lows. So it's very up, like look at the strong uptrend. And then price starts to exhaust itself. So when you get a lower high and a lower low, that means that trend is no longer valid now, right? If you had at the same level, then maybe it just goes into consolidation. But once you get, instead of getting a higher high, higher low, you get a lower high and a lower low. Now you're in a downtrend, right? That's our definition of a downtrend. So that uptrend has been broken, which means that we could potentially get a downtrend, so which could be a better trade to take. Okay, so let's take a look at a couple more examples and then we will wrap it up. So here we have another example. See here, this is a triple bottom, right? We may not necessarily have had a triple, we don't always get a triple bottom. A lot of times we'll get double bottom, but the concept is the same. Price is coming down, hits a level where it's not able to break that level and then bounces off, comes back and tests the same level again, bounces off, comes back and tries it the third time around. It's not successful. In this case, our neckline would go right here. So we are basically, so ignore the third bottom here, it's just extra confirmation. But basically what you're looking to do is this. You're looking to draw some sort of a W. This area where your point of the W would be is your neckline. So once the price breaks through the neckline, you can take a trade while, see, once this candle closes above, you could take a trade as the price is pulling into this 50% of this candle. So I'm always looking for retracement because I get few extra pips as a result, but you don't have to. You could take a trade at the close of this candle because the neckline has been broken. Now your profit target, sorry, your take profit would be actually slightly below this one, just so we give trade more room to breathe. But usually if you have a triple top, once the neckline gets broken, usually it continues on. However, we never know. It's the markets, right? It could do whatever it wants to. So our entry is here on the pullback. Somewhere along the line here, we would take an entry, and our profit target would be, so in this case, is 27 pips is our stop loss. It would be 27 pips. So somewhere around here would be our profit target. And if you're trailing your stop loss, then you can get more. So you can get out here as opposed to here. But 1-to-1, this is a good 1-to-1 risk to reward ratio. If you're trailing it, then you can get, of course, once you get this pin right into R1 and you get an engulfing candle, that's a reversal pattern right there. So you want to get out of the trade. But before then, you didn't really have any solid reversal patterns. So that's how you would take a trade. In this case, it's a double bottom. Any more questions in regards to the double top, double bottom here? All right, so let's finish this off. Okay, so this example here, sometimes you can catch really nice trades with this pattern. So anytime you see a double top or a double pattern, pay attention to the trade. Try it in your demo account, see how it works out. In this was just a recent example that set up, so it was quite nice. 243 pips in the trade. We get out when we get the engulfing pattern in the opposite direction. So on a standard lot, that's 2430. Thank you, Sharon. Sharon says, very well done. I keep it simple. I'm glad to hear that. That's my strength of taking complex things and simplifying them. So if you would like to learn more profitable trading strategies, so the double top, double bottoms are one of my favorite chart patterns to trade. I love trading those because they're just so easy. Once you train your eyes to them, they're really easy to identify and usually pay out quite nicely. So if you want to learn more trading strategies like this one, I have a Forex course. You can go to tradingwithvenus.com/Forex course to check that out. And in the course there, I teach you technical analysis. So if you thought that, I can identify things on the chart and it seems like so simple, well, you can learn that as well, because I teach you how to identify the different candlestick patterns, the different chart patterns, all the reversal patterns. I have a whole module on reversal patterns. I teach you how to draw your support and resistance lines and your trend lines. Again, like I said, the reversal patterns are in there, and there are continuation patterns as well that we talk about, moving averages, Fibonacci, pivot points. So some of these things that you need to know in terms of a technical analysis, we cover all of those. I also teach you how to do fundamental analysis, so you know exactly what's going on in the broader market, so you don't get stumped by some of the things like what's the relationship between interest rate and prices, monetary policy. If somebody's doing quantitative easing, what does that mean? So all of that is covered. We also talk about risk management, equity management, and during this webinar here, we were talking about trade management. So what does that mean? I cover some of those concepts as well. And as a bonus, you'll also get my pivot point indicator. That was what you saw on the charts was the lines that you saw, the red, blue, and green lines. Those were my pivot point lines. And as we saw in that one example, the prices tend to bounce off of those quite nicely, and we can get some trades setting up. So it's a very nice indicator that I use. So I will give you that as well. I'm running a special promotion, and the price of the course is $297. You get lifetime access. Once you pay for, or once you buy the course, you always have access to it. And I keep adding stuff to it. Anytime I do a webinar, I do a special session, it goes into the course as well. So you have access to all the different my trainings that I have done. So right now it's $297. In the fall, I'm going to go back to the original price of $499. So if you're interested in learning any of these, I welcome you to check that out. And the website for the course is tradingwithvenus.com/Forex course. All right, any other questions before we call it a wrap? Okay, going once, going twice, 3 times. Perfect. So great. Thank you so much for joining me on this training. We have webinars every 2 weeks. If you want to sign up for the next webinar, just go to tradingwithvenus.com/webinars, and you will see all the free trainings, all the webinars that I have scheduled currently. And if there's usually a webinar every 2 weeks, so you can go sign up for that anytime you want to sign up. It will be there, or if you sign up to my newsletter, I will notify you when the next webinar is coming up as well. So I am great. Very grateful to people. First time I see some people who said this is the first time they've joined. So thank you for joining me. And I would love to continue this conversation on the next webinar. So please feel free to join as well. And enjoy the rest of your day. It's a nice sunny day out here. So go enjoy it. I will talk to you next time.